Hi everybody, this is Hustle Hub. I'm Giacomo, and today I'm going to analyze Visa. This is one of the stocks that you asked me to analyze. Before we get into the content of today, make sure to remember this is not financial advice, so do your own research before investing, and remember that investing takes risks, so be mindful of that. And second, I've taken the data from the website of the New York University, the part managed by Aswat Damodaran, that is widely regarded as one of the best experts in corporate finance and valuation. And I've taken the data regarding the stock itself on Seeking Alpha. You can get a discount on the Seeking Alpha subscription by going down in the link down below, and you can access articles from analysts, find all the financial data you need in order to make analysis yourself. So yeah, and a lot more. So make sure to check out the link down below. So let's get into the content of today. Visa. So let's start off with the calculation or the estimate of the weighted average cost of capital. For simplistic reasons, I've taken the interest rate swap for 10 years on the US dollar, that is around 4% at the time of this recording. So I've taken that because we make assumptions more or less on the next 10 years. So I felt that that was the most appropriate interest rate, risk-free interest rate to take into consideration. Then we take the risk premium, and according to us, what Damodaran this year for the US is 4.6%. And then we take the last 2 years beta for Visa, that is 0.84%. Another thing I want to mention, I usually use commas instead of points and points instead of commas. I know that you people in the US do the opposite, but over here we do it this way, and Excel likes it this way. So what are you gonna do? Then we take the same interest rate swap and add it by a spread that I estimate to be around 3%, because of course it's debt, but it's a riskier debt compared to the US government debt. So yeah, the spread takes that into account, and we come up with the WACC that is also given by the weight between debt and equity of how the company finances itself. This is data that I found on Seeking Alpha. So here's the weighted average cost of capital that I estimate to be around 7%, and I estimate it to go a little bit down the line, because I think that there's a consensus and an expectation for interest rates to go down. So yeah, so then we see some financial highlights for Visa, and we take what has happened in the last 10 years. So we start off with 2014, and we see the trend in revenue, earnings, and free cash flow. So the revenue has grown, the earnings even more, and we see that free cash flow has done very, very well year over year. This is a compounded annual calculation. So yeah, here's the formula if you want to see it. Yeah, and it's the same for the previous ones. Okay, so we start making assumptions for the future for Visa. So here's how I've made these assumptions. I want to stay conservative, because when you make assumptions, you need to stay conservative because the future is uncertain. So I've taken short-term growth for the stock slightly less, for the free cash flow, slightly less than what has happened in the last 10 years, just to stay conservative. And then we see it going down as the time goes. So yeah, we stay conservative, and I take the long-term growth to be 3%, because it's widely regarded that is the sustainable growth for the US in this case. for GDP in the long run. So I've taken this in order to stay conservative, and that's what usually corporate finance people would tell you to do for the long run for the calculation of the terminal value. So here's the formula and how I calculated the terminal value, and yeah, and here's the present value for the terminal value. Yeah, so I add these two, the free cash flows brought to the present value and the terminal value brought to the present value as well, and then I make some adjustments. I take into consideration debt and some expenses that are not yet realized, but they could turn out to dilute our value and our equity. So yeah, I've taken into consideration the net debt, the net position between debt and cash and other things for Visa, and that is around $2.9 billion. I've taken this also from Seeking Alpha. I've taken the options outstanding, so the options that Visa gave out to its employees to reward them for their job. So yeah, these could possibly dilute our value going forward if they're exercised, and it's almost certain that will be exercised because the weighted average exercise price is 162 and the current share price is around 270. So yeah, it would be very stupid not to exercise these options going forward. So I've made a valuation for the options, as I said in the previous video, just for simplistic reasons. I haven't gone through the Black-Scholes formula for simplistic reasons, but you have to remember that as you may know, the lifetime of the options make the options more valuable, but in real life, in the real world, options usually get exercised way before their expiration price. So yeah, maybe this figure is a bit less than the actual fair value for the options, but yeah, you have to take into consideration that probably the value is not that much higher. So yeah, make a few adjustments and keep in mind that you need to have a margin of safety. Then we have the restricted stock units and the performance stock units. I multiplied this figure for the current share price, and here's the result that I get. And here's how I've estimated what I think is the fair value of the equity. So then I divide this figure by the outstanding shares, and I find what I think is the fair value for the Visa stock. So it's 21% higher compared to what it's trading at as of now. But yeah, just remember, these are just assumptions, so you need to have a margin of safety because things can change and they can change your expectations very quickly. So let's see what happens if, for example, in the long run, the interest rates were to go higher. Let's make this rate 7.5%, and we can see how it changes our value. So it would decrease our valuation by a lot. So yeah, I think that it's more likely to see the rates go down rather than higher, but yeah, be mindful of that. And we can make a few assumptions on what would happen if the stock were not to perform as we would have liked. So let's make it this way, for example. Okay, and we see that the stock in this case would be valued actually less than what it's trading at. So yeah, but I think it's fair to think that Visa can do well over time, and it is also an edge against inflation because, as you may know, Visa makes a lot of its revenue from fees on transactions, and if the value of those transactions gets higher, they will make more money as a result of that. So it's an edge as well, on top of being a great company. So yeah, let's make it back to 3.1 for example, and we see that the value would be a lot higher. Yeah, it's you don't have that big of a margin of safety, but Visa has a strong moat. It's a great company. It's well positioned for the future. It has a presence all over the world, so I would never bet against Visa. And yeah, I would keep it on my watch list because in case it would get a little bit cheaper in the short run for not specific reasons, I would probably make it a buy. So yeah, so this is it for today. I'm Giacomo. This is also Hub. See you next time.